Okay, so let's continue from where we left. Let's continue from where we left. Last time we were discussing the topic of internal reconstruction. That's what we were discussing last time. And we were talking of how to reconstruct a company through what we were calling internal reconstruction. We were discussing how to reconstruct a company through what we were calling internal reconstruction. That's what we were discussing last time. Okay? So today, just a minute. There is something I've realized. Just a minute. There is something I'm realizing. Just a minute. Let's continue. Let's continue now. Just a minute. Okay, so let's continue. Are you able to clock in? Have you been able to clock in? You chat and say yes. Seems there is a problem. It seems there is a problem. Are you able to clock in? Hello, can we continue? Are you able to log in? There seems to be something wrong. You chat and say yes. Are you able to log in? Chat and say yes. There's something seems to be wrong. Yes. Oh, you're able to see me. Sawa. You're able to see me. Ah, good. Sawa. Good. You're able to see me now? Good. Thank you. Sawa. If you're able to see me, that's very good. There was something that was missing somewhere. So let me confirm something now. Now, say whether you're able to see me. Andika, you're able to see me. I want to know. Are you able to see me so that we continue? Write and chat that you're able to see me, because there was a technical issue I was trying to sort out. So I don't know whether you're able to see me so that we start. Chat and say yes, that yes, I'm able to see you. You're able to see me. Good. Thank you. Sawa. Good. So let's continue now. Good. You're able to see me. That's okay now. So let's continue. So what I was saying is this, that last time we did a topic of internal reconstruction. And we were doing the topic of internal reconstruction and we said, good, thank you. We said this, listen, that when you are required to reconstruct a company through internal reconstruction, listen, we said, as a company, all the stakeholders of the company are called into a meeting. All the stakeholders of the company are called into a meeting. so that they agree on how they can help the company in order to eliminate the accumulated losses, in order to help to eliminate the accumulated losses. So they had to come up with a scheme of internal reconstruction. And that scheme, you remember, we were calling it a capital reduction scheme. The aim was to reduce the capital of the business. And you remember we said, how do you reconstruct a company? Through internal reconstruction. We gave the accounting entries. Number one, you remember we said, with amount written off on share capital, we said you debit share capital. If you remember, you can see down here, we said you debit share capital, and we were saying you credit the account called capital reduction. You debit share capital and you credit capital reduction. Good. That was number one. Number two, we were saying with amount written off on liabilities, whatever the stakeholders agreed to write off on liabilities, we said to write off on liabilities, we said you debit liabilities. You can see from the left, you debit liability, and we said you credit capital reduction. That was our entry number two. With amount written off on liabilities, we said you debit liability and you credit capital reduction. That was number two. Number three, we said, with amount written off on assets, we said you debit capital reduction and you credit the asset. Whichever the question will tell you, you debit the capital reduction and we said you credit asset. You can see there. That was number three. Number four, we said, with accumulated losses written off, we said you debit capital reduction, you credit P&L. I hope you still remember we said accumulated losses are always a debit balance. And you can see here we opened an account called P&L account. It has a debit balance. And so we said to write it off, we credit P&L account and we said you debit capital reduction and you debit capital reduction. Good. That was our entry number four. But before we even go to number four, I remember telling you last time that there are some questions, listen, there are some questions from your past papers which do not remind you to write off the accumulated losses. I told you, even when the examiner does not remind you to write off the accumulated losses, you should still remember that the aim of reconstructing a company is to help eliminate the accumulated losses. So we said, whether the examiner reminds you as a note somewhere or he does not remind you, you still have to remember to write off the accumulated losses. We did a past paper question in the last class, and that was November 2016. And in that question, the examiner never reminded us to write off the accumulated losses. But we had to write off once we were through with the other scheme the question had given us. That was number four. Number five, we said with any contingent liability arising, you remember we gave preference dividends in arrears as an example. We said you debit capital reduction and you credit contingent liabilities. Then, of course, number six, we said with any balance remaining in the capital reduction account. That's what we did. Then we did that question. We did that question of November 2016. There it is. But today, now listen. Today, I want to develop the topic now. Listen carefully now as I'm developing now. Today, I want to develop the topic. Now listen. There are some questions again in your exams which don't give you the scheme of capital reduction. In that sense, the examiner does not tell you how much write off on ordinary, what assets to write off, what liabilities to write off, and so on. In other words, assuming you are an accountant and you have been called by company A to help them to reconstruct their company. You are an accountant and you have been called to help reconstruct this company. You will have to come up with a scheme of reconstruction. You will have to come up with a scheme of reconstruction. So how do you develop or how do you come up with a scheme of internal reconstruction. The way the last question we did, it gave us the scheme of internal reconstruction. Number 1, note number 2, note number 3, number 4, number 5, number 6. They gave us the scheme. Then we were only required to prepare the accounts and the balance sheet. But there are some questions I'm saying which don't give you the scheme. Instead, they want you to design your own scheme. Once you design your own scheme, then you now implement the scheme. In other words, how do you normally determine or prepare a scheme of capital reduction? How do you design or suggest a scheme of capital reduction or internal reconstruction? There are normally some steps that are normally followed. There are steps that are normally followed in designing a scheme of internal reconstruction. So today we want to discuss how to design or suggesting, don't write yet, what we call suggesting a scheme of internal reconstruction, suggesting a scheme of internal reconstruction. That's what we want to do now. Okay. Now, I have said there are steps that are normally followed in determining or designing a scheme of internal reconstruction. So let me go through those steps. Number 1, whenever you are appointed to reconstruct a company, the first thing you must do is to determine, that's step number 1, you have to determine the total loss. Determine the total loss to be written off. Determine the total loss to be written off. That's step number 1, determining the total loss. That means when we shall reconstruct this company, or in the process of reconstructing the company, how much will be the total loss that will have to be written off by this company? So to determine the total loss to be written off, you will have to ask yourself, in the process of reconstructing this company, what are some of the losses that the company will suffer in the process of reconstructing themselves? You will ask yourself, as a company, what are some of the losses the company will suffer in the process of reconstructing themselves? So you will identify the losses, whatever they are. We shall discuss them later. Then also, it could happen that in the process of reconstructing the company, there are some gains the company could make. Use those gains to reduce the losses. Whatever the gains you realize from the question, use those gains to reduce the losses. Once you do that, you get the net of those two, and the net of those two, that is what you now get as total loss to be written off. So that is step number 1 in principle, determining the total loss to be written off. Identify the losses the company will suffer in the process of reconstructing themselves. Number 2, what are some of the gains? We shall come back to them later. Good. Now, that's step number 1. Number 2, for purpose of illustration, let me assume that the loss to be written off is an amount of 5 million. I'm assuming the total loss to be written off is 5 million for now. We said, whenever a company is being reconstructed through internal reconstruction, I told you the stakeholders of the company are called into a meeting. The stakeholders of the company are called into a meeting so that we find out who among these stakeholders should be requested to suffer that loss. The stakeholders would include the ordinary, the preference, the debenture holders, and so on. Now, we want to know, because that's why we are calling it internal reconstruction. It is the stakeholders who should suffer this loss. Okay? So, we want to know among the stakeholders of the company, who among them should be requested to suffer this loss in step number 1. Now, to know who among them is to suffer the loss, listen, you will ask yourself, listen, if this company is liquidated, don't forget, we are not liquidating the company, we are reconstructing the company. But you will ask yourself, if this company is liquidated, we know the assets of the company will be sold. Whenever a company is liquidated, the assets of the company will be sold. And also, once the assets are sold, normally the liabilities will be paid in order of priority. Once the liabilities are paid in order of priority, listen, a time will come when the money will be gone, finished, that means the money will be finished, but in the order of priority, there will be a stakeholder here whose payment would not have been reached because the money is gone, and according to the order of priority, he will not have been reached to. Listen, it is that stakeholder, listen, who knows that even if he goes to court and asks for the company to be liquidated, the assets will be sold, these liabilities will be paid in this order of priority, and by the time the money is finished, you as a stakeholder, you may not have been reached, and therefore you will get nothing. Listen, in case the company is liquidated. So we go to such a stakeholder. It could be preference shareholders, it could be ordinary shareholders, it could be creditors, whoever they are. We go now to that stakeholder and tell them, instead of going to court and asking for the company to be liquidated and you will get nothing, why can't you accept to suffer this loss of 5 million? Why can't you accept to suffer this loss of 5 million with the hope that we as a company, we shall make a profit and you will be able to participate in that profit? So it is that stakeholder whom we want to know, who among them, that in case he goes to court and asks for this company to be liquidated. I've told you we are not liquidating, we are reconstructing. So we want to know who is this stakeholder who, even if he goes to court and asks for the company to be liquidated, he will lose. We cannot request, listen, we cannot request that stakeholder who knows that if he goes to court and asks for the company to be liquidated, he will be paid. Because he will say, after all, I am an investor. Where am I better off? Am I better off when the company is liquidated, or am I better off when the company is reconstructed? If the stakeholder knows that if he goes to court, he will be paid what is due to him, then he would rather go to court instead of suffering the loss of 5 million. So it is that stakeholder who knows that even if he goes to court and asks for the company to be liquidated, that person will still lose. That is the person we want to determine under step number 2 now. Listen to this now. So our step number 2 now, our step number 2 says, you do what? Listen, you prepare a distribution statement. You prepare a distribution statement of the sales proceeds. You prepare a distribution statement of the sales proceeds. Don't write. We prepare a statement of distribution of the sales proceeds from the sale of assets. From the sale of assets on the assumption that the company is liquidated. On the assumption that the company is liquidated, you prepare a statement of distribution of the sales proceeds from the sale of assets on the assumption that the company is liquidated, meaning assets will be sold for this much. That's what we shall realize. Then we start now asking ourselves, in order of priority, who should be paid first? Who should be paid first in order of priority. I do hope that you still remember your topic of winding up of companies. You must have done that before in the other subjects, I think company law and so on. The order of priority when a company is liquidated. That's what you must have learned. So let me take you through. The first liability to be paid whenever a company is liquidated, that liability is called the secured liability. Any liability that has security, that is a liability that must be paid first. So let us assume one of the assets we sold was land. Maybe we sold it for 10 million. And it has secured a loan of maybe 3 million. That is secured loan. That will be deducted direct because you know the asset itself. You know the assets covering that loan. So you remain with a net of 7 million. That's the first liability to be paid, any secured liability. Once you pay the secured liability and money is still remaining, the next liability to be paid is what we call liquidation expenses. You pay the liquidation expenses, whatever it is. Some books will call it winding up expenses or liquidators expenses, whatever it is. That's what we're saying. Once you pay the liquidation expenses and money is still remaining, the next liability to be paid is what we call preferential creditors. You pay what we call preferential creditors, whatever it is. Once you pay the preferential creditors and money is still remaining, the next liability to be paid is what we call debentures on a floating charge. Debentures on a floating charge, whatever it is. Once you pay debentures on a floating charge and money is still remaining, then what is the next liability to be paid? The next liability is what we call unsecured creditors. Unsecured creditors, whatever it is. Now listen. When it comes to liquidation of companies, when we refer to unsecured creditors, listen, we are not talking of only the trade creditors. No. We are referring to any liability that does not have security. That kind of a liability is what we classify as unsecured creditors. It could be a bank overdraft which did not have security. It could be a bank loan that does not have security. It could be the normal trade creditors. Any liability that does not have security, that is what we classify as unsecured creditors. So we are not referring to creditors alone. No, we are referring to any liability which does not have security, whatever it is. Good. Assuming we pay them and money is still remaining, now listen, a time now has come for you to pay the shareholders. According to the company, you may have preference shareholders and ordinary shareholders. Of course, you know from order of priority, the first person to be paid, what is due to them is the preference shareholders when it comes to order of priority. Another point, when it comes to preference shareholders, there are normally two things that you owe to them. One, it could be the preference dividends that are still in arrears and their share capital. Those are two things that you could be owing to the preference shareholders. One is their preference dividends which are still in arrears, and number two, any preference share capital. So the question again, in order of priority, what should they be paid first? Should they be paid the preference dividends in arrears first, or should they be paid their share capital first? Normally, in order of priority, they should be paid the arrears first. So you come and pay any preference dividends in arrears. Once you pay the preference dividends in arrears and money is still remaining, then it is that time now you come and pay the preference share capital. You now come and pay preference share capital. Once you pay the preference share capital and money is still remaining, listen, the last person to be paid are the ordinary shareholders. The ordinary shareholders, you pay them their preference, their ordinary share capital. Whatever money is remaining belongs to the ordinary shareholders. So I've just given you, listen, I've not used the list yet. I've only given you the order of priority on how liabilities are paid in case a company is liquidated. Number one, I've said you pay the secured creditors or the secured liabilities. Number two, you pay the liquidation expenses. Number three, you pay preferential creditors. You pay debentures on a floating charge. You pay the unsecured creditors. You pay the preference dividends in arrears. And you pay the preference share capital, and any money remaining now becomes or belongs to the ordinary shareholders, Now, going back to our step number one, we saw that this company has to write off a total loss of 5 million. Listen, suppose you go to the balance sheet of this company and you find, listen, you go to the balance sheet of this company and you find they have 600,000 ordinary shares of shillings 10 each, which gives you a capital of 6 million. And two, they have 200,000 preference shares of shillings 10 each, giving you 2 million. I'm assuming. Now listen. Suppose you prepared this statement, and as you went down preparing it, listen to this now. After you had paid the arrears, you remained with a balance of maybe 3 million after paying the arrears. So you now said, who is the next person? It is the preference share capital. So you went back to the balance sheet and you asked yourself, how much do we owe our preference shareholders? We owe them 2 million. So let's pay them. That's what we owe to them, that 2 million. So you paid the preference shareholders their capital of 2 million. That left you with a balance of 1 million. Listen, that 1 million now belongs to the ordinary shareholders. So you can see from this illustration that the preference shareholders have been paid everything that is due to them. It is the ordinary shareholders who, according to the balance sheet, we owe them 6 million, but in case the company is liquidated, they will only get an amount of 1 million. So we conclude now and ask ourselves, who among the stakeholders of this company should be requested to suffer the loss in our step number one? It is obvious, it is the ordinary shareholders. It is the ordinary shareholders. Why? Because the amount due to them, the amount due is 6 million. That's what we owe to them. That is for ordinary. Amount paid, that is paid, this is due. Amount paid is 1 million, which means the amount lost will automatically be 5 million. So step number two has helped us to conclude as to who among the stakeholders should suffer the loss in step number one. We cannot ask the preference shareholders. Why? Because they know if they go to court, they will be paid their capital and they will even be paid their arrears. So we can't ask them. Can we ask the debenture holders? No, because they know if they go to court and ask for this company to be liquidated, they will be paid what is due to them. But if the ordinary shareholders go to court and ask for the company to be liquidated, they can only get a maximum of 1 million. And as a company, we owe them 6 million, and therefore they will suffer a loss of 5 million in case the company is liquidated. So we tell them, instead of going to court and you losing 5 million, why can't you accept to suffer the same 5 million with the hope that we shall make a profit in the future, and you will be able to participate in that profit. So that's what we are telling them, that accept to reconstruct the company, not to liquidate. Accept that we reconstruct, so that in case we shall make a profit in the future, you will be able to participate in that profit. So we have come to step number 2. That means we have concluded. Now you go to step number 3. Listen, step number 3 is step number 3 requires you determine the loss reduction. You determine the loss reduction per share. You determine the loss reduction per share. The shareholders are to suffer a loss of 5 million. So to get the loss reduction per share, you take the total loss, whatever it is, you divide that by number of shares. You divide that by number of shares. I have not said you divide by the ordinary shares. It could be preference shares, it could be ordinary shares, whatever it is. So we take, according to our illustration, we take the 5 million loss that we got in step number 1, we divide by the number of shares. For this case, we are writing off on ordinary, and the ordinary shares were how many? According to our illustration, there were 600,000 shares. So we come to get the loss reduction per share. We divide that by 600,000. So that comes to how much? That comes to how much? I take that 5 million, we divide by 600,000. We divide by 600,000. That gives me something like 8.3 per share. So that is our step number 3, determining the loss reduction per share. Determining the loss reduction per share. So now we go to step number 4. We go to step number 4, where now you suggest a scheme. You now suggest a scheme. You suggest a scheme of internal reconstruction. You suggest a scheme of internal reconstruction. Listen. The question we did last time had 8 items the examiner gave us in their scheme. So now that you are designing your own, number 1 item to put in the scheme is exactly what you got in step 3. In our step 3, we have got that ordinary shares should be reduced by, ordinary shares to be reduced by 8.3 per share. So you come and say here, number 1, ordinary shares to be reduced by 8.3 per share. That's 1 item in the scheme. There are some questions that don't tell you ordinary shares to be reduced by. They say ordinary shares to be reduced to. Like the question we did, the examiner was telling us ordinary shares to be reduced to. You remember from this illustration, our par value per share was 10. So step number 3 says we are writing off 8.3. So if we are writing off 8.3, then it means we are remaining with a balance of 1.7. So instead of being told ordinary shares to be reduced by 8.3, it is the same as just saying ordinary shares to be reduced to 1.7. Good. Now listen. The other question now is, what should I include as item 2, item 3, item 4, item 5, item 6 in the scheme? Listen. What should I include? What else should I include to be part of the scheme? Listen, whatever else to be included in the scheme should be, listen, you go back to step number 1. Listen, you go back to step number 1. Anything that you used in the determination of that loss of 5 million, that should be part of the scheme. Anything that we used in the determination of the total loss, that should be part of the scheme. So, because I had not completed step 1, let me now complete it first. Before we go to step 4 and complete it, let me now complete step 1. When I was introducing step 1, I told you, determine the total loss to be written off. Then I just told you, identify the losses that the company will suffer in the process of them reconstructing themselves. I said, if there are any gains, use those gains to reduce the losses. Good. So we want to find out what are some of the losses that the company may suffer in the process of reconstructing themselves. Now listen, let us assume that before you as a company, you reconstructed yourself. One of your assets in the books had a value of 5 million before we reconstructed. One of our assets had a value of 5 million. But after reconstruction, that asset will go back into the books at a value of 4 million. That asset will go into the books at a value of 4 million. So automatically it means therefore that after we have reconstructed our company, we shall suffer a loss of 1 million. So one component that may give rise to losses is when there is a decrease in value of an asset. When assets reduce in value after reconstructions, that will automatically give rise to losses. What if you had another asset which had a book value of 5 million, but after reconstruction, it will go into the books at 6 million? Maybe after it has been revalued, it will go back to the books at 6 million. Maybe land had a book value of 4 million or 5 million, but the true fair value of the land is 6 million, meaning after we have reconstructed, it will go back into the books at 6 million. It's obvious as a company, we shall make a gain. So one of the components of the gain is when there is an increase in value of an asset, when there is an increase in value of an asset. Okay, good. That's number 1. Number 2, let me again assume that this time these are not assets. Suppose these are liabilities now. In other words, one of your liabilities had a value of 5 million. But after reconstructing the company, that liability will go back into the books at 4 million. Meaning our liability will be less after reconstruction than before reconstruction. It is obvious as a company we are gaining because our liabilities are decreasing. So any decrease in value of a liability, will automatically give rise to a gain. What if one of your liabilities had a book value or a value of 5 million before reconstruction, but that amount will go back to the books at 6 million. So we have a liability which will go into the books at 6 million. That means our liabilities are increasing. And when liabilities are increasing, that will give us a loss. So any increase in value of liabilities, that will automatically give us a loss. Good. What are the others? Of course, you remember when we were doing the question or when I was introducing the topic, you remember I said in the process of reconstructing yourself as a company, you may incur what we were calling reconstruction cost. In the process of reconstructing your company, you may incur what we were calling reconstruction cost. And of course, whenever you spend money to reconstruct yourself, will give rise to a loss. So any reconstruction cost, of course, will give rise to a loss. Another one, I told you last time, whenever a company is reconstructed, the accumulated losses must be written off. So, because the accumulated losses must be written off, as a company, we shall have to suffer. So, any accumulated losses which must be written off, again, will be part of the loss that the company will suffer. Good. Another one. I told you, whenever you are appointed to reconstruct a company, I said, you will normally gather information about this company as much as you can. You will ask the company to give you their income statement. You will ask the company to give you their balance sheet. And you will try to gather as much information as you can from this company. Suppose you realize that this company has a contingent liability. We said last time, a contingent liability does not appear in the balance sheet. But I told you, the moment you start reconstructing a company, that contingent liability should be crystallized, meaning you make it as a liability. How are we making it as a liability? We were debiting capital reduction, and we were saying you credit that contingent liability. If you know the name of the contingent liability, like in our case, you remember we were using preference dividends in arrears. That's like an example of a contingent liability that we used in the previous question. We said you must crystallize it. It does not appear in the books. It's not anywhere in the balance sheet. But now that we are reconstructing the company, any contingent liability should be crystallized. By crystallizing means you are making it as a liability. So before we reconstructed, we did not have a liability, but after we have reconstructed, now we shall have a liability. So that automatically will also give rise to a loss. So any contingent liabilities will automatically give rise to a loss. Any contingent liabilities will automatically give rise to a loss. Good. Now, in the process of reconstructing a company, if a company has any reserves, normally those reserves should be written off. Maybe share premium, could be general reserve, maybe revaluation reserve. All reserves should be written off. We all know reserves are amounts that belong to shareholders. So if we are to write them off, then automatically as a company, we shall gain. Why? Because these are amounts that belongs to shareholders, and therefore if we are to write them off, then as a company we are gaining. So another component that can give rise to gains are reserves to be written off. Reserves to be written off. Whichever reserve, whether general reserve, whether revaluation reserve, whether share premium, whichever reserve your company has. So listen, so I've identified for you the components that can give rise to losses and the components that can give rise to gains. I've told you any decrease in value of an asset will give rise to a loss. Any increase in value of a liability, any reconstruction cost that your company is incurring, accumulated losses, of course, they must be written off. Any contingent liabilities that must be crystallized, that will give rise to a loss. And gains, we have said, any decrease in increase in value of an asset, any decrease in value of a liability, and next is any reserves which have to be written off. Now listen, so I want to go back now to step number 4. I did step 4, but only one item I quoted in the scheme. Then I told you, listen, I told you, what else should I put in the scheme as number 2, number 3, number 4, number 5, number 6? I told you, it is at that point in time that you go back to step number 1. And I told you, anything that you used in the determination of that loss of 5 million, that which you used in the determination of that loss should be part of the scheme. Now that we have discussed it, now go back to step number 4. So, number 1, I've told you, anything you used or you got in step 3 should be part of the scheme. In our case, with amount written off on ordinary shares. Now, number 2, you could say, I'm going back to number 1. In number 1, some assets were to be revalued. So you could say assets to be revalued to their fair values as follows: machinery, motor vehicle, furniture, building, and so on. So that once some of the assets are revalued, Some of them will increase in value, that will be a gain to us. Some of them will reduce in value, that will be a loss to us. So that's another item you can put in the scheme. That's another item you can put in the scheme. Next one, you could say liabilities to be revalued as follows. Liabilities to be revalued as follows. Again, some of them will increase in value, some of them will reduce in value. Those increasing in value will give us a loss. Those reducing in value will give us a gain. Okay. Another thing we used in step 3, we talked about reconstruction cost. So you can say reconstruction cost of shillings, maybe 2 million to be incurred. Reconstruction cost of 2 million to be incurred. That could be what you are spending to reconstruct your company. Next item we used in step 1 was the accumulated losses. So you can come and say here, accumulated losses to be written off. Accumulated losses to be written off. Another item we used in step 1 was any contingent liability. So you could say preference dividends in arrears to be paid in cash. Preference dividends in arrears to be paid in cash. Don't forget, we have said preference dividends in arrears is an example of a contingent liability. Good. Then you could also say maybe share premium to be written off. It's one of the reserves that maybe your company has. Share premium to be written off. Maybe it's general reserve, maybe it's revolution reserve, whatever it is. So this is how you come up with a scheme of internal reconstruction. So those are the steps that are normally followed in designing a scheme of internal reconstruction. I've told you step number 1, determine the total loss to be written off. Step 2, prepare a distribution statement of what? Of the sales proceeds from the sale of assets on the assumption that the company is liquidated. Why do we prepare this statement of distribution? On the assumption that the company is liquidated. I'm saying we are not liquidating, we are reconstructing. But you prepare a statement of distribution of the sales proceeds from the sale of assets on the assumption that the company is liquidated. We have said this is done so as to determine who among the stakeholders of the company should be requested to suffer the loss in step 1. Could we request the preference? Can we request the ordinary? Can we request the debenture holders? It is from step 2 that you will be able to conclude who among the stakeholders is to be requested to suffer the loss in step number 1. We have given the logic that even if he goes to court, he will still lose. So we just tell him, accept to suffer the loss in step 1 with the hope that we shall make profit and you will be able to participate in that profit. That's step number 2. Number 3, I've told you, you determine the loss reduction per share. How? By getting the total loss, you divide that by the number of shares. You divide that by the number of shares. Then I've told you, now you go to step 4. I've said, one item to be put in step 4 is what you got in step 3. How much was the loss reduction per share? Then I've told you item number 2, 3, 4, 5, 6, 7, 8, and so on. Now you go back to step number 1. Anything that you used in the determination of the loss to be written off should be part of the scheme. Good. So let's put down the summary notes now. Let's put down the summary notes on that now. Let's put down the summary notes now. So the topic is, andika another subtopic, andika another subtopic, andika another subtopic. As a subtopic, suggesting a scheme, suggesting as a subtopic, suggesting a scheme of internal reconstruction. That is the subtopic, suggesting a scheme of internal reconstruction. Suggesting a scheme of internal reconstruction. Suggesting a scheme of internal reconstruction. Then you say this. Say this. Sometimes one may be required. Sometimes one may be required to suggest. Sometimes one may be required to suggest a scheme of internal reconstruction. Sometimes one may be required to suggest a scheme of internal reconstruction. Then you say this: the following are the steps to be followed. The following are the steps to be followed. The following are the steps to be followed in designing. The following are the steps to be followed in designing a scheme of internal reconstruction. The following are the steps to be followed in designing a scheme of internal reconstruction. The following are the steps to be followed in designing a scheme of internal reconstruction. So andika step 1. Step 1, put it this way. Step 1, determine, put it that way. Number 1, determine the total loss. Determine the total loss to be written off. 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 Determine the total loss to be written off as follows. Determine the total loss to be written off as follows. Okay, then you see here losses. We have said number 1 is any decrease in assets. Whatever it is, we have said increase in liabilities. Whatever it is, we have said reconstruction cost. Whatever it is, we have said accumulated losses. To be written off. Accumulated losses to be written off. Whatever it is, then we have said contingent liabilities. Contingent liabilities, whatever it is, get the totals. So 1 is any decrease in assets, increase in liabilities, reconstruction cost, accumulated losses to be written off, and any contingent liabilities. Then you now come and say less gains. Less gains. You less the gains. What are some of the gains? We have said increase in assets. Whatever it is, decrease in liabilities. Whatever it is, then we have said reserves to be written off. Reserves to be written off. Reserves to be written off. Whatever it is, then you get the net there, and that's what you call total loss to be written off. Total loss to be written off. Total loss to be written off. So that's step number 1. That's step number 1. So finish, we want to go to step 2 now. So finish copying, we want to go to step 2. Okay. So if you're through, Put down step number 2 now. Step 2. Put down step number 2 now. Put down this way. Prepare, sema hivi. Prepare a distribution statement. Prepare a distribution statement. Prepare a distribution statement of the sales proceeds. Prepare a distribution statement of the sales proceeds. Prepare a distribution statement of the sales proceeds from the sale of assets. Prepare a distribution statement of the sales proceeds from the sale of assets on the assumption that the company is liquidated. On the assumption that the company is liquidated. Prepare a distribution statement of the sales proceeds from the sale of assets. Prepare a distribution statement of the sales proceeds from the sale of assets on the assumption that the company is liquidated. On the assumption that the company is liquidated. Will stop. And you say this. This is done. This is done so as to determine. This is done so as to determine. This is done so as to determine who among the stakeholders. This is done so as to determine who among the stakeholders of the company, who among the stakeholders of the company is to be requested. Who among the stakeholders of the company is to be requested to suffer the loss in step 1. This is done so as to determine who among the stakeholders is to be requested to suffer the loss in step 1. Comma, i.e. whether it is the ordinary shareholders, preference shareholders, debenture holders, creditors, etc. i.e. whether it is the ordinary shareholders, preference shareholders, debenture holders, creditors, etc. etc. Then you say this, the process is carried out. The process is carried out as follows. The process is carried out as follows. The process is carried out as follows. Now let me put down something first. Don't copy fast. Let me put it down. I think now you can copy. Now you can copy. I've put there sale of assets. I did not want to say motor vehicle, furniture, building, and so on. I just said sale of assets. Then you minus the secured liabilities because those ones must be deducted direct from the asset. Then I've said you add cash and bank. Those two, cash and bank, you don't sell. They're already in liquid form, so you don't sell them. That's why we are adding. After we have now that, you pay the next liability in order of priority. I've paid the secured. We have said you less liquidation expenses. Once you less liquidation expenses and money is still remaining, we said you less preferential creditors. You less preferential creditors, whatever it is. Once you pay the preferential creditors and money still remaining, we less. Sorry. What did we say you pay after you pay the preferential creditors? I told you pay debentures on a floating charge. Debentures on a floating charge. Once you pay debentures on a floating charge and money still remaining, we said you now pay what? You less unsecured. We said you less unsecured creditors, whatever it is. Once you minus the unsecured creditors, assuming money still remaining, I told you now you pay the preference shareholders. What do you pay them first? We said you pay them preference dividends in arrears. Preference dividends in arrears. That's what you pay them first. Assuming you pay them and money still remaining, now you come and pay the preference share capital. Come and say a less preference share capital. Whatever it is. Once you pay the preference share capital and money still remaining, I told you now you pay all of it or you give it out to the ordinary shareholders now. Ordinary share capital. And that's what you give them as their net. That will leave you with nothing. That will give you with nothing. Yes. Nyawera has a question, you can chat. Nyawera has a question, you can chat. Just chat the question, I'll see it on the screen. Cecilia, you have a question, just chat. Chat the question on the screen, I will see it. You chat on the live chat, I'll see the question. You chat, I will see the question. Okay, meanwhile, while you are chatting, we can move on. You can write your question in the screen. I'll see it. Okay, so let's now go to step number 3 now. We have done step 2. What is debentures on a floating charge? What is debentures on a floating charge? Hey. Sharon. Now, whenever a company, listen, whenever a company says, we want to borrow money from the bank, but the bank is allowed, listen, whenever you refuse to pay the loan, they can come and take any asset of yours. Meaning, it is on the general assets of the company. It's not on a specific asset. That loan is not like the one which was secured on the land. Land was used as a security for the loan. That is a specific asset that was used as security. So that is said to be secured liability. But when you come and borrow from the bank and you tell them you want to use your general assets, then in case you refuse to pay the loan, they can come and take any asset. So in that case, we say the debenture is secured on a floating charge on the company's assets. On a floating charge on the company's assets. Somebody's asking, what about a fixed charge? A fixed charge is now where you have a specific assets. Where like the land was used as a security for the loan. So the loan has a fixed charge on assets called land. Are you there, Sharon, now? Sharon is asking, what about a fixed charge? A fixed charge is like that loan we have been talking about. It is secured on land. That's a fixed charge. Okay, but a floating charge is where it can cover, they can recover any asset. Kindly allow us to copy from liquidation expenses downwards. higher. Sawa. Go on now. So somebody is saying, I allow them to copy from liquidation expenses downwards. So I hope now, let me start from the top. We said sale of assets, whatever the total. Then I talked about you minus the secured liabilities. That is a liability which is a fixed charge on assets. Then I said you add cash, whatever it is. Then you minus liquidation expenses. Then I said you minus preferential creditors. When money is remaining, you minus debentures on a floating charge. When money is still remaining, you minus what we call unsecured creditors. When money is still remaining, you pay the preference dividends that are in arrears. And when the arrears have been paid, you now pay the preference share capital. And finally, once you pay the preference share capital, now you pay the ordinary share capital. Once you pay the ordinary share capital, there will be no balance remaining. Any money remaining belongs to the ordinary shareholders. Any money remaining belongs to the ordinary shareholders. So finish. We want to go to step number 3 now. We want to go to step number 3. I hope the person who was copying is through. So that is an order in which you should remember. That order is important. There are some questions that test you, not directly as suggesting. Accruals are unsecured. Accruals like electricity owing, insurance owing, those are unsecured creditors. Are you there okay, Lillian? What about accruals? Accruals will fall under these. Accruals will fall under unsecured creditors. They are liabilities which have no security. So if in your balance sheet you have accruals like electricity, water, telephone, insurance, all those are part of. Okay, sawa. Now you have understood. Thank you, Lillian. Sawa. Good. Okay, Daniel. Sawa. Now let's go to step 3 now. So andika step 3. Determine the loss reduction per share. Determine the loss reduction per share. That's number 3. Determine the loss reduction per share. Below that, you can say equals to total loss. You divide that by number of shares. Total loss, you divide that by number of shares. Total loss, you divide by number of shares. Total loss divided by number of shares. Good. That's step number 3. I have not said ordinary. I have not said preference. It can be any share. Then number 4. Step 4. Prepare or suggest. Put it that way. Maybe we could put it that way. Suggest. Step 4. Suggest a scheme of internal reconstruction. 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 Okay. Suggest a scheme of internal reconstruction. Now, listen. There I cannot say, number one, ordinary shares to be reduced by this much, two, assets that way. No. Why? Listen. For number four, we can't put the items now because we don't have the figures and we don't have which items. So it is just the suggestion. So it will depend on the question. So I can't say ordinary shares to be reduced by this much, assets to be revalued to this much, and so on. Now that we shall do when we are doing a question. But for this part of the notes, we can't say number 1, 2, 3, 4, 5, 6, no. In the scheme, no. Because we don't have the items. So we just say, suggest a scheme of internal reconstruction. We shall do that when we are doing a question, because from the question, we shall be able to pick the figures and to know what will be part of the scheme. Okay? Now finish. I want to talk about something small. Again, before we do a question now. Finish. I want to talk about something small before we do a question now. Now, I hope you are through with the copying. I hope you are through with the copying. I hope you are through with the copying. Okay, sawa. So let me take you back. Listen, I want to take you back to step number 2. Yes, I want to take you back to step number 2. Here. Listen to this now. Suppose, I want you to listen carefully now. Suppose in your balance sheet, you have 400,000 shares, ordinary, of 10 each, giving you a capital of 4 million. This time, you have 200,000 preference shares of again 10 each to give you a capital of 2 million. Listen to this now. Our loss, I am still maintaining, for purpose of illustration, I'm still maintaining a loss of 5 million. That is what I'm assuming we got in step 1. So step 2, prepare a distribution statement, blah, 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 blah. Now listen. Suppose you started preparing this. You came preparing it downwards, downwards, downwards. Listen, I'm changing something now. Assuming that after you have paid the arrears, after you have paid the arrears of the preference dividend, you remained, after you have paid the arrears, listen to this now, you remained with a balance of 1 million. I'm assuming from the top, everybody has been getting what is due to them. But when you paid the arrears, now you remained with a balance of 1 million. Of course, we have said, after paying the arrears, the next liability to be paid is the preference share capital. So you go to the balance sheet, listen to this, and you now realize that we owe the preference shareholders 2 million, and we owe the ordinary 4 million. But now, as far as this is concerned, now we have only 1 million. So I'll give all of it. If I give all of it to the ordinary, because that's the preference, that will leave us with nothing. So listen carefully now. So from here, you should conclude who among the stakeholders should suffer the loss in step 1. I have assumed that you have gone to the balance sheet. You realize that we owe the company 4 million in terms of ordinary. We owe the preference 2 million. When you are doing your step number 2, after you had paid the arrears, you remained with the balance. of 1 million. The next liability is preference share capital. We have only 1 million, but we owe them 2 million. So you gave them the whole 1 million and money was gone. So the question is this now: who among the stakeholders of the company should be requested to suffer the loss of 5 million in step 1? I hope you have noticed now that from this step 2 now, it is both the ordinary shareholders and the preference shareholders. If you look at this now, our summary would say this. This is amount due. Don't write now. Due, paid, and amount lost. For ordinary, we owe them 4 million. If they go to court and ask for the company to be liquidated, will they get anything? No. So they get nothing. So they lose the whole 4 million. Preference shareholders, from the balance sheet, we owe them 2 million. If they go to court, they can get only a maximum of how much? 1 million. So they lose how much? 1 million. So we can see now the total is coming to how much? 5 million. So according to step 2, it is the ordinary shareholders who should suffer the loss and also the preference shareholders. Ordinary shareholders should suffer a loss of 4 million. Preference should suffer a loss of 1 million. Listen, if that is your conclusion, then you will go to step 3, which says determine the loss reduction per share. Listen to this now. If you go by what step 2 is saying, then it means on ordinary, we are writing off 4 million. That's the loss. So you come and say your loss to be written off. Then you come and say on ordinary, their loss is 4 million. We divide that by, listen, divide that by number of shares. Our company had 400,000 ordinary shares there of 10 each. So if I divide 4 million by 10, that means ordinary should lose 10 shillings. Then I come and say preference. They are to suffer a loss of how much? 1 million. We divide that by the number of shares, and their number of shares are how many? 200,000. So we divide this by 200,000. That gives me 5 shillings. Now listen carefully now. If we go by that, and we now go to step 4, in step 4, I would say, listen, number 1, ordinary shares to be reduced by 10 shillings per share. Listen carefully. It means this. Our company had 400,000 shares of 10 each. Now, from now on, we are writing off 10 shillings per share on the ordinary. It means that after reconstruction, this company will not have ordinary share capital. They will not have ordinary share capital because according to step 2, they are to lose 4 million. So when I come to step 3 to determine the loss reduction per share, I realize they are losing 10 shillings. On their 400,000, they would lose 4 million. Listen carefully now. It is obvious the ordinary shareholders will not accept that kind of a proposal. Remember, they are the owners of the company. They have called you. They know you are an accountant. They have called you to help them to reconstruct their company. So you gathered the information. Then you started determining who should suffer the loss of 5 million. Then you realize, according to step 2, the ordinary shareholders are to lose all their capital. It is obvious. It is not practical. There is no way you can reconstruct a company and leave it without ordinary shareholders. Without ordinary shareholders. They will not even, listen, they will not even accept your proposal. So you don't even go to step 4 to suggest a scheme. Because when you go telling them that you will write all of them off and they will no longer be shareholders, they would even tell you, leave us with our company. We appointed you, now you are telling us we shall no longer be the owners of the company. It's not possible. They will tell you, leave us with the company. So you will not even go to step 4 to suggest as per step 3. No. You will have to look for another way now. Because it is not practical to reconstruct a company and leave it without ordinary shareholders. So we want to find out, what should you do in a case where, what should you do in a case where the ordinary shareholders are to lose all their capital, which is not practical. Now listen. So we must structure the company in such a way that the ordinary shareholders, listen, the ordinary shareholders will be left with a little of their nominal value, with a little of their nominal value. Currently, one share has a par value of 10. Leave them with a little of that nominal value. Maybe you could leave them with 1 shilling per share, or you could leave them with only 50 cents per share, but not write everything off. That's not practical. We don't have a company which doesn't have ordinary shares. So the question is, how can we reconstruct the company so that we leave the shareholders with a little of their nominal value? Now, what you can do is this. You can go back to the preference shareholders. Remember, according to this table here, the preference shareholders were to lose 1 million. We could only pay them 1 million in case the company is liquidated, and they would lose the other 1 million. So we go back to them and tell them something like this, that instead of them losing 1 million, why can't they accept to suffer a bigger loss? Instead of suffering a loss of 1 million, let them suffer a bigger loss. So that what we did in step 2 here, instead of giving them the whole 1 million here, let's give them part of that 1 million, so that the other part now will remain for the ordinary shareholders. So you reconstruct in such a way, or the scheme should be effected in such a way that the ordinary shareholders will be left with a little of their nominal value. And I'm saying this can be done by requesting the preference shareholders to suffer a bigger loss. Maybe, let us assume that we want to leave the ordinary shareholders now with only 50 cents per share. Currently, the amount due for ordinary is 4 million. We want to leave them with only a little of their nominal value, which is 50 cents per share. The company had 400,000 shares of 10 each. Now we want to leave them with 50 cents per share. So 400,000 times 50 cents, that means we leave them with 200. So we tell the preference shareholders, instead of giving you the whole 1 million as we got earlier, let us now pay you only 800. So that we are left with this 200 to be given to the ordinary shareholders. So that you preference shareholders, yes, we owe you 2 million. We now pay you 800, so that your amount lost, you as ordinary shareholders now, so that the amount lost as ordinary will be 4 million minus 200, that will be 3.8. For preference, 2 million minus 800, that will be 1.2. That will now come to a total of 5 million, which is the same what we got in step 1. So we are saying that in a case where the ordinary shareholders are to lose all their capital, we have said that is not practical. The scheme should be effected in such a way that the ordinary shareholders will be left with a little of their nominal value. How can you do that? By requesting the preference shareholders to suffer a bigger loss, so that part of the amount will be paid to the ordinary shareholders. Listen to my question now. You are the preference shareholders in this company. You know this, that in case you go to court and ask for the company to be liquidated, you will be paid 1 million. So you'll only lose another 1 million. But here is a company which is being reconstructed. And they're asking you, listen, they are asking you to suffer a loss of 1.2. So as a shareholder who is an investor also, you will ask yourself, where am I better off? In case I go to court, I'll lose only 1 million. These guys want me to lose 1.2 million in the reconstruction. As a preference shareholder, will you accept? It is obvious again, you will not accept, because you are better off if the company is liquidated. Now listen. So for the preference shareholders to accept our proposal, as a company, we must do something. In other words, listen, you must also look for ways of compensating. You must also look for ways of compensating the preference shareholders. Now, for that additional loss, you may tell them, please accept to suffer a loss of 1.2, but we are going to compensate you for the loss. How? You may tell them something like this, that whatever we owed you in terms of preference dividends in arrears, our dividends or the dividends in arrears, your dividends in arrears, we shall convert them to ordinary shares. So if you tell them that way, they might say, okay, if you convert our preference dividends that are in arrears into ordinary, then we shall be part of the management. Why? Because ordinary shareholders have a voting right. So they may accept. Another way to compensate them, you might tell them, previously you were earning a dividend of 10%. That was your dividend rate. But from now onwards, we shall be paying you at a dividend rate of 20%. Meaning you increase their dividend rate. You increase their dividend rate. Sawa. That's another way in which you can compensate them. So, what am I discussing now? We are discussing a scenario where in case the shareholders, ordinary shareholders, lose all their capital in the reconstruction process. I've told you that is not practical. I've told you the scheme should be effected in such a way that the ordinary shareholders will be left with a little of their nominal value, which in our case now, we want to leave them with 50 cents per share. If we leave them with 50 cents per share on their 400,000 shares, we want to leave them with only a capital of how much? 200. Then out of the 1 million that was remaining, we give our preference shareholders 800. So that the ordinary will now suffer 3.8 and preference now will suffer 1.2. Once they accept, we have said you look for ways. Now you can go to step 3. Once they accept, now you can go to step 3 and now say loss reduction per share. Now you don't take 4 million, divide by 400. Now you take 3.8 million, because that's how much the ordinary share are losing. You divide that by 400, that will come to 19.5. Don't forget you're only leaving them with 50 cents. So it's obvious they are losing 9.5, not 19. One share at a par value of 10. So they are losing 9.5. Then preference, they are now losing not 1 million, but they are losing 1.2. Divide by 200, that means they lose 6 shillings. Now you can go to step 4. That's what we are saying. That in case where the ordinary shareholders are to lose all their capital, we have said it's not practical. The scheme should be effected in such a way that the ordinary shareholders will be left with a little of their nominal value. We have said this can be done by requesting the preference shareholders to suffer a bigger loss so that we leave the ordinary shareholders with a little of their nominal value. We have said the preference shareholders should be compensated for the additional loss. How? By either converting their dividends in arrears into ordinary shares or by increasing their dividend rate. So let's put down that information now. Let's put down that information. We take another 2 minutes or so to put down that. So andika somewhere NB note. NB note. NB note. Then you say this. In a case where, NB note, in a case where the ordinary shareholders, in a case where the ordinary shareholders are to lose, in a case where the ordinary shareholders are to lose all their capital, in a case where the ordinary shareholders are to lose all their capital, in the reconstruction process, comma, in a case where the ordinary shareholders are to lose all their capital in the reconstruction process, comma, this would not be practical. This would not be practical. This would not be practical since it would leave the company, without ordinary shareholders. It would leave the company without the ordinary shareholders. It would leave the company without ordinary shareholders. We'll stop. Continue. Therefore, the scheme should be effected. Therefore, the scheme should be effected in such a way. Therefore, the scheme should be effected in such a way. The scheme should be effected in such a way that the scheme should be effected in such a way that the ordinary shareholders, would be left. The ordinary shareholders would be left with a little. The scheme should be effected in such a way that the ordinary shareholders will be left with a little of their nominal value. The ordinary shareholders will be left with a little of their nominal value. We'll stop. This should be effected in such a way that the ordinary shareholders will be left with a little of their nominal value. We'll stop. This can be done. This can be done by requesting. This can be done by requesting the preference shareholders. This can be done by requesting the preference shareholders to suffer a bigger loss. This can be done by requesting the preference shareholders to suffer a bigger loss. So that part of the amount would be paid to, the ordinary shareholders. So that part of the amount would be paid to the ordinary shareholders. So that part of the amount will be paid to the ordinary shareholders. Continue. Another paragraph. the preference shareholders should be compensated. The preference shareholders should be compensated for the additional loss. The preference shareholders should be compensated for the additional loss. Stop. This can be done by either. This can be done by either converting. This can be done by either converting the preference dividends in arrears. This can be done by either converting the preference dividends in arrears into ordinary shares. This can be done by either converting the preference dividends in arrears into ordinary shares, or by increasing their dividend rate, or by increasing their dividend rate. Good. Okay, we have no time to do a question now. So I want to talk to the new students. First, I have to start by apologizing. At the start of the program, there was a hinge. So that was a hinge that was there. I apologize for that. But now I want to talk to the new students. Because today it was a free class. So I want to talk to the new students. If you wish to continue with us, for this advanced financial reporting, we normally have either early morning classes or evening classes. I'm talking to the new students now. Our early morning classes starts from 5:30 in the morning to 7 a.m. in the morning every Monday, Wednesday, and Friday. That is for early morning, from 5:30 in the morning to 7. If you choose evening, it is from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. Okay? Our system is such a way that in case you miss a class, you can still go back to the group where the link was posted and you watch the video of the class that you missed at your own free time. So whenever you miss a class, you don't have to panic. You can still get the video of the class that you missed. Okay? Now, for this also, you can also buy what we call the pre-recorded videos. Maybe you want to buy the videos for the whole syllabus at once. You can buy what we call the pre-recorded videos. Okay? So if you are interested, you can call me on this number 0722 65 8875. 0722 65 8875. Good. That's our program for advanced financial reporting, either early morning or evening class. Early morning 5:30 to 7, evening 8 p.m. to 10 p.m. I've told you can also buy our pre-recorded videos if you feel you cannot attend any of the two sessions. But I've also told you that in case you miss a class, you can still watch the video of the class that you missed at your own free time. Now, some of you have friends who are doing financial reporting. We also have financial reporting, and the classes for financial reporting of the intermediate level are every Tuesday, Thursday, and Friday from 8 p.m. to 10 p.m. Again, it applies. In case they miss a class, they can still watch the video of the class they missed. We also have financial accounting, of the foundation level. That's what used to be called Fire Section 1. We also have it. So for your friends who are doing that, either financial accounting of the foundation level or of the ATD, we are also offering it. Okay. I would ask you, everyone now, if you can, please subscribe. Please subscribe to the YouTube channel. You subscribe to my YouTube channel so that you can get notifications of future videos that are posted to the group. My YouTube channel is called CPA Joseph Njuguna. CPA Joseph Njuguna. You can go and subscribe. You click the subscription and you click also the notification bell so that you get notifications whenever you want to, or whenever we post a video. Now, for all the classes, sorry, I forgot to mention that currently we are charging 4,000 shillings. We are charging 4,000 shillings, but we also accept payments on installment. We charge 4,000 and we also accept payments in installment. So maybe for now I can stop there. I don't think I've left out anything else concerning the new students. I think I've given you all the information. When are the classes, either early morning or evening. I've said you can also buy pre-recorded. If you want to call me on this number, 0722 65 8875. Good. Otherwise, good night. So next time, we shall now do a past paper question. So on Wednesday, we now do a past paper question on this area now. We now do a past paper question on this area. Otherwise, good night. Sorry for the interference that was there in the beginning. It took a bit of time. Fine. Otherwise, for now, good night. I don't know whether we have any students who can say something. Any new student who want to comment on something? Or we don't have? Good night also. James Kiama. See you. Good night. Fine. So for the new students, you can call me if you want to call me using that number. Good night. So let's see you on Wednesday. Have a good night, everyone. Have a good night, everyone. Good night.